What's up, everybody? Good morning. Welcome aboard Trading with Bubba, Tuesday, October the 24th. And markets look like shit, excuse me, but they don't look good. They're up this morning once again, but I think this rally will once again fail. I think there's a lot of information out there that is not so good for markets. The economy's in horrible shape. Inflation is flying. And yesterday, the 10-year notes hit 5% on their way to 6%, but right now they're just under 5%. Which again is not a good thing, and it's the yield curve. Short-term money is a lot more expensive than long-term money, which is backwards. There's just not a lot of reasons to believe we're going a lot higher. But as we take a look at markets, we'll take a look at the short-term view here. These are very short-term charts, 4 minutes, but it looks to me they failed about where they should fail from. Okay, we'll see if they can get back up there, but I think this is, as I said, nothing more than a short covering rally. I think when you look at the bigger picture, you can look at the SPY, for example. If my machine would stop, and you can say the resistance is going to be somewhere around 425, and then if it gets through there, about 428. But the trend is lower. It's clear that the trend is lower. We're going down. Okay, you're getting a natural net dead cat bounce in the Russell, the IWM. Okay. But again, made the head and shoulders pattern, broke the neckline, headed south. I would think that if it rallies, the best it'll do is get back to like 169, 170 potentially, if it'll get that high. And I think we have to remember that you want to be with the general direction of the market. You want to be with what we would call the path of least resistance. And the path right now of least resistance is certainly lower. Okay. I think when you take a look at just down the board now, the one fly in the ointment that this week will bring it next week is a lot of earnings. Today, you've got Google after the close. Okay. Now, where's it going to go? Well, it's already rallied. Okay. And Google happens to be still in an uptrend. So, we'll see. Now, one of the trades that I typically use myself is Google. Okay, for example, the expectations of price movement, which is determined by volatility, in Google for the rest of this week is $7. Okay, so it's about 6%, 5.5%. If Google moves 10% either direction, okay, I will be a buyer or a seller. I will take the opposite side of either trade. If it goes up too far, I will sell it. If it goes down too far, I will buy it. And that'll be strictly for a trade. And the way that I will typically trade those types of trades is by selling a deep in the money call or put spread, depending on obviously which way it goes. But basically what I'm creating is I'm creating an at the money put or near the money put or call that I'm going to be a buyer of. But by selling the spread and giving up the potential for unlimited profit potential, I am actually buying that put or call for usually around half price. Okay, and that's something that we want to look at. For example, I don't know if I can simulate today because of the high volatility here, but if I sold the 133, 139 vertical in Google for 380, so I've got a 220 risk. Okay, and if I look at the 139 put, it's 350. So I'm actually buying that put for $2.20 instead of 350. So ask yourself, which is a better trade? Is Google going to go much below 133? Now, I wouldn't do this now. This is a trade that I'm going to make after the numbers come out, after the earnings are announced. That's when I'll be looking to make the trade. So, in other words, I cannot make this trade until tomorrow morning. I'm not going to try to guess it in advance. I'm going to let the stock move whichever direction it moves and then go to make the trade. Okay. The same goes to get Amazon this week. Now, there's nothing to do now, but Amazon's expected move is about 7%. Okay. And again, if it moves 10% plus or minus, I will take the opposite side. And I think that's one of the things you want to learn is it's known as mean reversion. Now, I'll share with you the Bollinger Bands. Okay. Now, I don't use them because I can kind of see it without them. But that if we get a 10% move higher, for example, the market's going to be way overbought. Okay, now that doesn't mean that it has to come down, but the probability is that it will come down and we'll have some mean reversion. Okay, and I made this trade last week in Netflix. It did not work. It was a losing trade, but I made it. And again, I made it right here. I sold the call spread a little bit too early. Okay, and of course it was a small loser. But again, I'm buying a put or a call option. In this case, it was a put option at half price to what it was on the board. So my risk became half of what anybody else was doing to make the same type of position. And I think that's something that you have to recognize is where are you in the market, okay? And of course, another big thing is if you do have positions on going into earnings, okay, and you're taking a potential flyer or a shot, one of the things you can use is you can use the stock, okay? The stock and the options when they're in the money are the same thing. So you can actually trade in the post or pre-market by buying or selling stock. If you're covering a put, if you're long a put and the market's going way down, you can certainly buy the stock, and you can buy, if you have one option, you can buy 20, anything for up to 100 shares, which is the same as trading that option because you own the right to exercise that option later. Okay, so you can actually trade options synthetically through the pre or post market if you get a dramatic move in your favor and you want to cash part of that trade in. Typically, if I'm using a one lot, okay, to be an example, I'll buy or sell 50 shares of stock. So basically taking off half of an option, and then I will complete the trade when I'm ready to complete it. Okay, and these are things that you can use. These are tools that you can use in the marketplace to take advantage of off hours, because of course how many times have you seen a market move dramatically either for you or against you in the post or pre-market, and then by the time you got to the advantage and trying to get out, it had already moved the other way. Okay, so that is something that you need to be aware of and how to use the markets to your best advantage. Okay, so again, as we look at the markets, we want to make sure that we understand where our best opportunities come in. And of course, I'm just going to go back and take a look at what's going on as long as we're here. And I am trading live while we're here. Now, I have no trades to really make right now because there's really not enough action. But I will be looking to be a seller, okay, up against those resistance levels. And of course, as we look at some of the other products around the market here, you've got crude oil, excuse me. You got crude oil, which is selling off hard, which is kind of interesting when you think about it. Okay, that with all the trouble in the Middle East, which is where the oil is coming from, oil is going lower, and I think that you want to recognize. You get people who think that they understand and know better. Okay, and people say, well, you got to be a buyer of oil, and I'm not saying that oil is not going higher. What I'm saying to you is that oil reached 95 about 3 weeks ago. Okay, the Middle East crisis happened about 2 weeks ago. We've not even come close to that high in crude oil since that had happened. Okay, so again, don't let news or other events affect your thinking. Everything you need to know is right in this chart here. I don't care whether you're trading crude oil or you're trading the spiders. Okay, it doesn't really matter. We know that the spiders have solid support at 420. We know that this market's in a downtrend. We know if it breaks that support, then we're going to want to use that 420 as a resistance level to come back and be a seller later. Okay, if it holds that and it can take out some resistance levels on the way up, then the trend may indeed change. Okay, we don't know and we don't care. Okay, because if we're going to use and do our jobs properly, it is to read the market footprint. Whether you're looking, like I said, at the spiders or you're looking at the Qs. Okay, again, they're all going to work the same, and notice how they're all holding. And if you remember one thing for sure, okay, all charts are the same. Okay, all that happens is the time frames change. If you look at what we call universal price, okay, the markets themselves are always the same. Okay, And the charting that you're doing, the patterns that you're reading, okay, don't matter whether I'm looking at a full day or I'm looking at a 4-minute chart. Okay, the patterns themselves will repeat over and over again. And I think that when you start to recognize that, you will find yourself in a much better position, okay, to create better opportunities for yourself to make money. Okay, and again, everything comes down to what time frame that you want to trade on. Okay, it doesn't matter. There's no better or worse time frame. Okay, the real difference is that time frames change depending on how active and how fast you want to be in the market. Okay, so when you're looking, you're deciding what my trading plan is. How active do I want to be? Do I want to be real active? Do I want to be partially active? That's a decision for you to make, okay, on your own as to what you think is the right trade for yourself. Okay, now again, you can switch, but don't ever switch and mix one trade by different time frames. If you're making a trade based on a 5-minute chart, for example, then that trade should close off of that 5-minute chart, not change it to a daily or an hourly or whatever. Okay? These are things that too many traders and too many people try to finagle with. Okay, and you have to remember that the market is what it is, and your plan has to be consistent, which means that every trade you make, you must know your exit plan. It's easy to enter the market. It's not also always so easy to get out. Okay, and if you don't set up a proper plan and a proper exit, okay, like I know for myself, when I'm trading off of these charts, okay, I know what my stop is on every single product here. So if I make an entry, I know exactly where I'm getting out should an exit have to be taken. Okay. And I also know how I'm going to manage that trade if it goes in my favor. Okay. But my initial exit, my initial stop is what it is. So for example, if I were to sell the Dow futures right here, and I'm just using it doesn't matter what it is, but I know if I were to sell them at 33,330, I know that I'm using a stop that is above. Thank you. I know I'm using a stop that's above the most recent high. Okay, so if I'm using that, I know that I'm using 60 ticks above that most recent high. Okay, and at the end of the day, that's all I care about, because I'm not getting out early. I'm not selling early. Okay, I know that we are going to exit at that point. The only adjustment I will make to that stop is should the market itself change, okay, and start to go in my favor, okay, then I will start to look in that area and move with the market, okay. As it goes in my favor, I will start adjusting my stop to continue to lock in profit, okay, but for no other reason. Okay, I'm going to look for opportunities to lock in profit. And that's kind of how we roll in having an idea of where your exit's going to be. But as I look at the overall picture, and as I've said, basically the markets are in trouble. Okay, now again, they may go higher. We're in a very bullish time of the year. Okay, we're coming up. You've heard of the Santa Claus rally. You've heard of all those things. But again, we have had the occasional Black Christmas. Okay, a few years ago we had Black Christmas. I think this is going to be a bad fourth quarter. Now again, it's an opinion, and it's based on the markets as they sit today. But the markets can change. Okay, again, I'm not going to make a commitment for any longer than whatever period that I'm going to trade on. But for now, until things change, every rally, in my opinion, should be sold. Every opportunity to get short this market should be taken. And again, you have to decide your best way to get short. Do you short the equity if you're trading the equities? Do you use futures? Do you buy put options? Do you sell spreads? The one recommendation I will give all of you, especially you options traders, is don't sell naked options. It's kind of dumb. it doesn't do you any good because you can create a better position by selling even a wide spread. But you're paying 9.5% margin interest to carry a position for, let's say, say you're margining 20,000 when you could only margin 2. So you want to pay 98% on 20, or you want to pay 98% on 2? Okay, for basically the same type of action. So I think that too many of us make that mistake and forget about the other things and other costs that come into the market, come into play, that we have to be aware of at all times. And I think too many of you, make that overall mistake, not thinking. And again, the other side of it is the amount of risk that you have to take. Okay, the business of trading is a risk business. If you're risking more than you can afford, if you're risking more than you're comfortable with, then you're creating your own problem. Okay. And risk, leverage is a dangerous tool. It's great if you understand it. Risk is your mental side of the trade. Okay. If you can't take the pressure of the amount of risk you're taking, then you're trading too big. The size that you're trying to trade is too big for you. And I think those are all things that you have to put in together as part of a trading plan, which decides on risk. The objective to say, well, I want to make $100 a day or $200 a day is kind of silly, okay? Because not every day is going to fit. And just for example, this morning with my futures traders, we traded for an hour. We didn't make a trade. Okay, yesterday we made one trade. We had a winner, but it was one trade. There isn't enough activity. So if you're trying to pressure yourself to make X per day, not all markets, not every day is going to have the opportunity to let you make that money. And I assure you that if that's your objective, you're going to make a bad trade trying to create that whatever it is you're trying to make every day. And of course, if you lose it one day, how many days does it take to get back on track, right? So it takes 2 to get back on track. Okay, actually takes 3, right? You got to cover the loss and then get back to 2 days. So it's something that you have to think about as a trader, okay, and have a plan for it. So if you're using goals that are too short term that can't necessarily be achieved, you're really putting yourself into jeopardy versus putting yourself in a place of being advantageous. And I think that's something that we have to remember and look at. So as we go back and take a look at some of the charts going forward, and some of the major equities, Apple's got earnings next week, but Apple is stuck in a range between 170 and 180. Oh, let me change this back to a daily. There we go. Here's the support: 170, 180, 175 is a swing in Apple. Okay. Amazon we looked at, but again, 124 to 132 is the levels you'd be watching, but they got earnings, so that's going to throw a monkey wrench into it. Okay. Coin, okay, is broken out today. Now, again, the real key here is this blowing off, okay, or is this going to hold? So the real key to watch here is the 80 level on the upside, okay. Microsoft has earnings, I think, today as well. Okay, so what is it? Yeah, tomorrow. Okay, this is stuck. It's 320 to 340. Okay, so if you're identifying levels and you don't have to look for much, NVIDIA is stuck 400 to 440. The Qs are 360, 355 to 370. Square is 40 to 45. Again, these are things that you look at and you're looking for levels, okay, to create potential execution. Okay, that is, again, something that you want to be focused on, okay? You want to look at the market. You want to look at the chart. Tesla came down to almost to its support at 200, and it looks like Tesla's between 200 and 240. Okay, and these are things, again, no matter what chart you look at. Okay, the win is found support. Okay, right at 88 or so, and bouncing, and resistance up around 94. Again, focus on the pattern, focus on the direction, and focus on levels of support or resistance, knowing that you want to be a buyer. If the trend is higher, you want to be a buyer on a pullback to support. If the trend is lower, you want to be a seller at resistance on a rally. Okay. And then, of course, comes in what we call the blow-up trade, which is, here's one it's actually in a future, but I'm going to show it to you anyways because it's one that I did make. So I talk about ones I did make. Okay, now I had sold cattle. Okay, and I'd sold cattle way up in here. Okay, and suddenly, look at this. It got what we call a blow-off pattern, a panic down. And I said, okay, I'm going to buy it in the morning because obviously it doesn't trade all night. So I said, I'm going to buy it this morning. I bought this one, covered my short this morning, and look at go back up again. And all I'm really doing is looking for another opportunity to sell it again. But I wasn't going to let the opportunity of the blow-off get away from me. Okay, I was going to make sure that I was able to capitalize on the trade and the idea that I had. The pattern told me that there was a greater likelihood that it was going to bounce off of this. Whether it's going low or not is not the issue. The issue is that why should I give up the profit and create a bad trade out of a good trade when I can certainly re-enter at any time I want? And I think this is something that you have to focus on, is understanding the type of speed and the type of panic or emotion that is playing out in the markets on a regular basis. And if we go back to our charts here, or I put Apple in somewhere by mistake. Where was it? Oh, there it is. I got to put the Russell back in there. Hold on one second. Okay. So as we're watching here, you're now seeing a potential panic sell-off here. Thanks, Mike. You're looking at a potential sell-off panic here, okay, in some of these markets. Now, again, does that mean that we're going to jump in right now? No, it just means that it may be creating a short-term buying opportunity. Again, I'm trading on 4 minutes. So if I get enough volume in here, and I would have to see volume like in the NASDAQ up to here. If we get volume up to here on this bar within the next 2 minutes, I might be a buyer here. Okay. And not because I'm bullish, but because the pattern suggests that you're seeing a panic. Okay. And anytime that you see a panic or what we call the blow-off pattern, okay, it is a time that you may want to consider to get involved. It is a time that you may say, this is an opportunity for me to get involved with a trade and potentially make some money off of the market itself. Now, I'm not saying that it's going to get there, but we've made on the call together here, we've made a couple of these trades, okay, and we've been right on almost every one of them. Now, again, we're not always going to be right. It just happens to turn out that when we've been together, that the trades have been right. But right now, they're not showing it, but they're getting closer, okay? And I'm not telling you that you should make them. I'm telling you that these are trades that I look at making on a regular basis, and on a very short time frame. My expectations are that I'm going to see some sort of a recovery from here. If I find an entry, I'm going to get some sort of a V-shaped recovery. And if I'm not, well, I already know where my stop's going to be. So I know my exit. My exit's been decided. I don't have to think about it. I don't have to discuss it. I don't have to fret about it. All I do is I know exactly where I'm getting out should the entry come into play. Okay. And right now, it's really not enough for me to want to get involved. So I'm going to go ahead and pass this and see if it continues here. Again, if the volume was way up here, I would be much more inclined to look. But we're a little short. So there's not enough emotion playing out in these markets right now for me to decide to want to jump in. Okay. And it's pretty much across the board. And just so you know what these are, this is the Dow Future, Russell, crude, 10-year notes, gold, euro currency, S&P, and NASDAQ, which equates to the diamonds, the Russell, the IWM, the Qs, and the spiders. Okay, same thing, same type of chart. I assure you that if I put the spiders in there, okay, here's a spider. Take a look at that. Actually, I'll put it next to it. Here, there's the S&P, and here's the spider chart. They look pretty much the same. All that they don't have here is the overnight trade because there is none. Okay. But overall, they look the same. Okay. And that is something that, again, just recognize, what you're looking at and what you're trying to look at and how you're trying to benefit. Because, again, it's a game of putting yourself in the best position to make money. And all you can do is create the best opportunities for yourself. My words to you today are just be careful. Don't let your emotion get in the way. Don't let your mind get in the way. And I will see you all here. I'll see you tomorrow with the Wealth 120 update, but on Thursday for another show. Have a great day, everybody. Be careful and look for some opportunities to sell these markets. Have a great day, everybody. We'll see you later.